Well, welcome everyone, and thank you for joining our first ALTA Insights webinar of 2025. I'm Jeremy Yohe, ALTA's Vice President of Communications. And if you're looking to learn about key trends that will shape this year's housing market, well, you're in the right place. We've got a great presentation that's going to dig into a lot of data that will play into home sales, originations, and will help you maybe game plan the next 12 months of the year for you. Need to go through a few housekeeping items before we get into the presentation. Today's webinar is being recorded. You'll get a link you'll get an email with a link to the recording tomorrow. You will also get a link in that email to download a copy of today's presentation. You can download a copy of the presentation now from the handout section in the GoToWebinar window pane. If at any time you have questions, submit them through the questions box. We'll hold some time at the end of the presentation for Q&A. Do need to thank SoftPro for sponsoring today's ALTA Insights presentation. And before introducing today's speaker, we have a short message from SoftPro.
Artificial intelligence, it's the future, but what does it mean for you as a title professional? SoftPro's AI Guide series has the answers. In Part 1, we break down the basics of AI and explore the benefits for your business, along with potential risks to security and privacy. Part 2 delivers 6 practical examples of AI tools in action and a simple 5-step roadmap to get started. Check out our free AI guides now to learn more.
Almost played it twice there, SoftPro. You almost got 2 bites of the apple there. And it wasn't AI, it was just my own mistake. So, all right, SoftPro, thank you for that message. Keep an eye out for information about AI from us over the next year, as this technology will definitely keep evolving the title space. All right, with that, let me introduce today's speaker. Not a stranger to ALTA webinars and conferences. Joining us today, we have Odeta Kushi. Odeta is the Deputy Chief Economist at First American Financial, where she leads development of analysis, commentary, and forecasts on trends in the real estate and mortgage markets. Her research focuses on economic trends impacting real estate, including demographic shifts, affordability, and housing supply. Odeta, thank you again for joining us. I need to make you the panelist so you can share your screen. Maybe if I can click the right button. There we go. Nope. Is it not shifting to you?
Not yet.
Well, that's bizarre. We practiced this right before 1 o'clock.
We did practice it. I can confirm it worked seamlessly. If you would like to share screen,
Does it give you the option to share your screen?
It does not actually.
No.
I don't see it anywhere.
Oddly enough, it's just gray and it's not.
Oh, there we go. We did it.
12th time was the charm.
We did it. Okay, perfect. Hopefully you can see my screen.
What's the Fed to do?
Perfect. Okay, fantastic. Well, thank you, Jeremy, for the introduction. Many thanks to ALTA for hosting and SoftPro for sponsoring this event. And thank you all for taking time out of your day to listen to our 2025 outlook. We know it's been another tough year in the housing market. On a cumulative basis, total mortgage applications ended 2024 just above 2023 levels. And when we rank every year from 1990 through 2024, only 5 years had lower levels, and they were in the early 90s, so 90, 91, 94, 95, and then of course 2023. So we'll get into the specifics of our outlook throughout the presentation, but I think 2025 will in many ways resemble 2024, but with some progress towards normal. So with that, I would like to jump into a discussion of the macroeconomic picture and where we go from here. So of course, we have to start with a discussion of inflation. And there are two primary measures of inflation, both of which I'm showing on the chart you're looking at here. We've got the Consumer Price Index, or the CPI, and then the Personal Consumption Expenditures Index, or the PCE. There are methodological differences between those two. For example, the CPI only includes out-of-pocket medical expenses, while the PCE includes medical expenses paid by employers and governments. The Fed prefers the PCE, and specifically the core PCE, which excludes the volatile food and energy components. So the Fed's target inflation goal is 2%, as we all know by now. How are we doing according to both of these measures? Well, according to the core CPI, inflation is at 3.3%, and according to the core PCE, we're a little bit closer to target at 2.8%. But what's true for both measures is that significant progress has been made since inflation peaked in 2022. But as you can see in the last couple of months, we've sort of been stuck. Not a ton of movement downwards in these measures. So inflation's been a little bit stickier than the Fed had hoped or had anticipated. And of course, there are a lot of unknowns this year when it pertains to fiscal policy. But I'll get to this point in a minute. Stubborn inflation and a strong, resilient labor market, strong jobs reports for November and December have taken away any urgency on the part of the Fed to cut rates. I think at this point, the underlying inflation trends look healthy, but again, they're not happy about the stickiness that we're seeing in these last couple of months here. But let's peek under the hood a little bit. In this chart, I'm breaking out the CPI by its primary components. So core goods and super services, super core services rather. You might be thinking, well, I've heard of core services, but what's super core? Well, because shelter is such a major component of the services sector, and on its own, it makes up about a third of the overall CPI and more than 40% of the core CPI, we split it into its own category due to its weight. So how are we doing on inflation when we look at it by its components? Well, in the goods sector, you can very clearly see the spike here in 2022. We know that in the early days of the pandemic, demand for physical goods soared as consumers were confined to their home and they couldn't spend on things like concerts and travel or dining out. And of course, the health crisis blocked supply chains, meaning goods weren't hitting the shelves as quickly as consumers wanted them. So these supply and demand dynamics really resulted in a skyrocketing of goods inflation. You can see it peaking above 12% in 2022. Goods inflation has since come down. Supply chains have eased. The initial pandemic craze of consumers like fixing up their homes and upgrading their home office, that's faded as well. And our spending has shifted from goods into services. And so that's allowed goods to actually go into some deflation here, right? So we're in negative year-over-year growth territory in the goods sector. So that's really helped inflation to come down more generally. Now, super core services is very labor intensive. It's industries like healthcare, education, recreation services, financial services, and that is still above the historical norm here. But where we need to make the most progress is with shelter inflation. That's this orange line here. You can see that's well above historical norms. But here's the tricky thing about shelter inflation. Shelter inflation is primarily driven by changes in the rental market. And due to the way it's measured in the CPI, it actually lags observed prices or rents in this case by about 12 months or maybe even longer. So rent declines on new leases are very slow to show up in this measure. So let me try and alleviate some inflation concerns one at a time here. Services inflation is still elevated, as we just showed, and labor is the sector's main input. That's why the Fed has been paying very close attention to the service sector wage growth, which has been growing faster than the overall rate of wage growth, which has led to fears of a wage price spiral. The good news here from this chart is that service sector wage growth is decelerating, and we can also see that the quits rate in the labor market is below pre-pandemic levels. which means that workers aren't feeling super confident about leaving their jobs for another job. And we'll talk about this in more depth in a second, but a couple of years ago, workers were leaving their jobs en masse, right? It was the Great Resignation because they knew they could leave their job and easily find another job that would pay them more money. And that was really driving wage growth in our economy. Not the case today. The quits rate is below pre-pandemic levels and workers are staying put. And that's correlated with slower wage growth, and that's exactly what we're seeing. So not a ton of concern of a wage price spiral. And another takeaway from this chart is take a look at the annual growth in private wages and salaries. That's the green line here. In the third quarter of 2024, that wage growth slowed to 3.8%. The pace consistent with the Fed's inflation target is 3.5% if productivity growth is at 1.5%. But the thing is, productivity growth today is 2.5%. So wage growth at 3.8% is basically below the pace consistent with 2% inflation. In other words, we have non-inflationary wage growth. So from the Fed's perspective, this is great news because it's a sign of a balanced economy where workers benefit without compromising the Fed's goal of controlling inflation. All right, so I said before that shelter inflation is primarily driven by changes in the rental market, and due to the way that it's measured, it lags observed rents by about 12 months, sometimes even more. So rent declines on new leases are slow to show up in the inflation index. So here we're looking at new tenant rent index, and you can see, so this is rent on new leases. It's been falling sharply since the summer of 2022. And this decline will eventually show up in the CPI shelter component. In fact, it's already showing up and helping to drag that shelter component lower, which will drag overall inflation lower and closer to the Fed's 2% target. Now, the Fed knows all this information, so they have some confidence that inflation will continue to make progress. Lots can happen, of course, but our baseline expectation is that inflation will continue to slowly move towards the Fed's 2% target this year. Now, I'm going to do a quick digression here away from the macro, but I thought it would be of interest to this audience. I just mentioned that we've been seeing rent growth deceleration, and in some markets, even rent declines on a year-over-year basis. But as with all things in the housing market, it's local. So we know there's been a lot of apartment building, which all else held equal can put downward pressure on rents. But in this chart, what you can see is the x-axis is new excess stock as a percent of inventory. So how much are we building? How much supply coming online relative to the existing stock? So it's sort of a measure of oversupply. And then the y-axis is your rent growth. You see a very clear negative relationship here. The more building relative to stock, the more downward pressure on rents. So in the bottom right quadrant here, which is dominated by markets in the Southwest and Sun Belt, you have more building and negative annual rent growth. Top left quadrant, dominated by markets in the Northeast and Midwest, less building relative to existing stock, and you still see positive rent growth in these markets. So certainly some regional dynamics at play here when we talk about rent growth. And I wanted to bring in the slide because we don't really talk about multifamily in this presentation. I mostly stick to residential, but I do think it's important to bring up. Okay, back to macro. I can't help myself. I'm always drawn to the real estate data. So inflation is making progress, but has stalled a bit. How's the labor market? The other mandate of the Fed, right? 2% inflation, and then we have our labor market goals as well. We want to maintain full employment. I would explain the labor market as cooling but resilient. And I'll tell you what I mean by that. So in this chart, we're showing the unemployment rate and the prime age labor force participation rate. In January 2023, the unemployment rate was 3.5%, very, very low. Today, it's 4.1%, still historically low and below the natural rate of unemployment. So I'm not seeing any red flags in the unemployment rate just yet, but certainly it's an indication that the labor market is cooling from, again, that 3.5% unemployment level. Another sign of some cooling, payroll growth averaged 165,000 in the second half of 2024, which was down from an average of 207,000 in the first half of the year. So gradually cooling. Not bad, but less good. Now, full employment isn't just about the unemployment rate, it's about maximizing participation in the labor force. And as you can see, the prime age participation rate remains above pre-pandemic levels. It's slipped a little bit in recent months, but again, above that pre-pandemic rate. This metric measures the percentage of people aged 25 to 54 who are either employed or actively seeking work. I specifically use the prime age because it avoids distortions caused by older people retiring or younger people pursuing education. Now, a higher participation rate means most people who want to work are either employed or actively seeking work. So it's good to see that this rate has made progress post-pandemic. Now, I wanted to break down what's caused the rise in unemployment since that January 2023 3.5% unemployment rate. And pretty consistently on a month-over-month basis, most of the rise in unemployment is driven by job losers who are failing to find work quickly. Because if you look at all the reasons that someone could be unemployed, you could have good reasons for unemployment, if you will, such as new entrants to the market or re-entrants to the labor force. But in this instance, it's a bad reason, which is that those who have lost their jobs are failing to find work. And I'll explain why that is. So this chart is using the JOLTS data to show job hires, openings, quits, and layoffs. There was a point in the post-pandemic labor market when we were characterizing the labor market as the Great Resignation because employees were feeling really confident about their ability to leave their jobs and find something better. And this put upward pressure on wage growth. The labor market has changed. In today's environment, quits are below pre-pandemic levels, so workers are staying put. Job openings have come down, and while layoffs are still low, hiring is weaker, which is driving the unemployment rate slowly higher. I do expect that trend to continue this year, but my baseline expectation is that the labor market will slow, but not collapse. So with the labor market resilient but slowing, how is the US consumer doing? We know that US consumer spending makes up 70% of economic growth. The US consumer is king. And we also know that consumer spending has been pretty resilient in our economy. And that's really been thanks to positive real wage growth, as we talked about in a previous slide. So if wage growth remains positive, we can see ongoing resiliency for the US consumer, which is good news for the economy, good news for the Fed's goal of achieving a soft landing, which means that we can tame inflation without tipping the economy into the recession, which, by the way, is still our baseline case for this year, is that we achieve that soft landing. But that's not to say that there aren't headwinds for the US consumer. Notably, in this chart, we're showing that consumer excess savings have been depleted. The chart is showing you that the accumulation over the pandemic from lack of spending and government stimulus, and then the subsequent drawdown of those excess savings. So the lack of excess savings is one headwind to consumer spending. Additionally, credit card debt, both in nominal and inflation-adjusted terms, is on the rise. And since the end of 2022, the delinquency rate on credit card debt has risen from about 7.5% to almost 11%. So some of the spending is being financed with credit card debt that consumers are struggling to repay. So consumers have been shown some resiliency. I think that's in part due to positive real wage growth, but certainly they are facing headwinds, especially among lower income consumers who are really feeling the cumulative impacts of inflation over the last several years. So let's pull this all together. Here you're looking at the Fed's projections for 2025 and beyond. The Fed is telling us in their projections that they do expect the labor market to slow. Their unemployment forecast, you can see here, 2024, 4.2, 2025, 4.3. So they're saying slow, but not collapse. And they also expect inflation to remain sticky. So the PCE inflation forecast for the Fed for 2025, in September, they were thinking we would reach 2.1%. They increased that forecast to 2.5%. So they think that inflation is going to be a little bit stickier for longer. And as a result of those two factors, labor market slowing, but not collapsing, and inflation remaining stickier than anticipated, the U.S. central bankers now project they will make just 2/4 percentage point rate reductions by the end of 2025. That is 0.5 percentage point less in policy easing this year than they anticipated in September. And so again, that's really a function of the fact that they believe inflation is stickier, maybe some uncertainty in fiscal policy and its impact on inflation, and the fact that the labor market's been a little bit more resilient in this higher rate environment. I should note that the dot plot projections on the right here, those are the individual interest rate projections of every single FOMC member. So the 2 rate cuts I mentioned earlier are just medians. This chart shows you that 1 official sees no rate cuts this year, 3 officials see 1 rate cut, 10 officials see 2 rate cuts, and another 3 officials see 3 rate cuts. Just 1 official sees 4, and another lone official sees 5. So there's some dispersion here, but the median is 2 rate cuts in 2025. Current target rate is 4.25 to 4.5%. And this you're looking at here is market expectations of Fed rate cuts this year. And interestingly, the market actually expects fewer rate cuts in 2025 than the Fed. So right here is the Fed's expectation. And then, about 36% of the market is expecting, 1 rate cut, and another 18% think that rates won't move this year. And so the markets are they're moving around very quickly depending on the incoming data report. So if you have an incoming data report that shows, hotter than expected inflation, then you'll see investors sort of pricing in fewer rate cuts. If you see data coming in that shows a slowing labor market or lower than anticipated inflation, then you'll see a swing back into more rate cuts. So this will move around a lot, but the market is generally sort of in line with Fed expectations. Though I should say that the expectations for Fed rate cuts have come down significantly, and that's had an impact on mortgage rates. Speaking of mortgage rates are not directly tied to Fed decisions, as you can see in this chart. There are instances when mortgage rates will move around a lot, this green line, and the Fed funds rate doesn't move at all. So there's not a one-to-one relationship between the two. Instead, mortgage rates are loosely benchmarked to the 10-year Treasury yield. The 10-year Treasury yield can move around for all sorts of factors: geopolitical conditions, economic conditions, investor demand, Fed policy, you name it. It can move around that 10-year Treasury, and then of course mortgage rates will move as well. And really, the discourse around the timing and pace of potential rate cuts is what's been driving near-term path of interest rates, rather than the actual policy itself. So in other words, mortgage rates are really pricing in potential Fed decisions before the Fed makes its decision. I do think that there is room for rates to come down this year from today's levels, because the baseline expectation is that the Fed will cut rates, even if it's fewer than we thought last year, will cut rates this year to return policy to a more neutral stance. And even if yields don't come down, if we get some compression in the spread between mortgage rates and yields, that can result in some downward pressure on rates as well. And when we look at the industry projections for interest rates, they are aligned with that perspective. If we take the average of some industry estimates for the rest of the year, it's showing that we'll end the year at rates still above 6%, but certainly better than where they are today at about 6.3% ending 2025. And I think that's sort of my baseline expectation as well. And that will set the stage for the remainder of the presentation, where I discuss where I think sales, affordability, and all of that is heading. So I have takeaways for each one of the sections here. You can read that in the deck. I won't spend too much time on it since we've already covered it. And I want to move on to the next section, which is all about the demand side of the housing equation. And when I'm talking about the long-run demographic tailwind, I'm really talking about the millennial generation, the largest living generation, surpassing the baby boomers, who are continuing to age into their prime home buying years. But before I do that, I just want to show how much demographics matter in the housing market. We know that generations come in waves. Smaller generation is followed by a larger generation, and so on. So when baby boomers came along, they were the largest generation in history. They were followed by Gen X, which is a smaller generation. then the millennials, who are an echo of the baby boomers, and then of course you have a smaller population in Gen Z. When looking at the overall population by age, you'll see these peaks and troughs at different ages as a larger generation makes its way through life. And these waves, these peaks and troughs, have a huge impact on the housing market because they shape demand dynamics based on where in the housing consumption life cycle that generation is. When we're young, we live with our parents, then we eventually move out. We tend to rent first, get a bunch of roommates and rent before transitioning into homeownership. And as we age, it's typical to see consumption of housing increase, and then eventually decline as we downsize, move in with children, move to a retirement community, etc. So peak millennials were born in 1990, 1991. So this year they're 34, 35 years old, again, still aging into those prime home buying years. So since we're talking about generational trends, I wanted to show you the average homeownership rate by generation. So we're comparing generational homeownership rates at the same age. So if you look at the age of 30, the millennials have a homeownership rate that's about 6 percentage points lower than their generational predecessors, the Gen X and the baby boomers. And then, of course, if you look further along the curve here, that gap between the millennials and the Gen X homeownership rate has gone away entirely. And that's because despite the fact that millennials have this misnomer as the forever renter generation, millennials are interested in homeownership and they are buying homes. They're just doing it much later in life because they've delayed these lifestyle decisions like getting married and having kids until their early to mid 30s compared to previous generations who are making these decisions in their mid to late 20s. And so again, I think this is evidence of this trend that the gap between the homeownership rate between generations really narrows as you go later and later in this age axis here. Another standout here that you might notice is Gen Z, this yellow line, if you can see it, really starting out strong, right? The homeownership rate for that, early 20s Gen Z is quite high relative to their generational predecessors. We think this is a bit of a one-off because a lot of it had to do with how low interest rates were and remote work opening up, that more possibilities for Gen Z to purchase homes in places that are more affordable. But as you can see, as you get to the 25-year-old Gen Z, the trends seem to be lining up with millennials. And so something to keep in mind there. Now, importantly, millennials, largest generation, aging into their 30s, and we anticipate that the population of 30 to 39-year-olds will continue to increase until at least 2030. Additionally, millennials are the most educated generation, and their higher educational attainment is translating into higher earning power, which is a strong determinant of homeownership rate, of homeownership. Their homeownership rate is just over 50%, which leaves many more younger households who want to make the same transition. We know that in the short term, high mortgage rates and a challenging affordability environment is causing them to delay, but not deny their transition into homeownership. Now, quickly, since we're talking about demand, I wanted to show some population trends. So this is the 2022 to 2023 annual population growth. A couple of takeaways here. Sunbelt markets have had a growth in population. So you've got Jacksonville, Austin, Orlando, Raleigh, Dallas, Houston taking up the top spots. On the opposite end, you've got LA, Pittsburgh, New York, San Francisco, Buffalo. So, there's markets that are traditionally more expensive or lower amenity or have slower economic growth rates are the ones that are seeing, negative population growth here, whereas markets that have a growing economy or our higher amenity markets are seeing some growth. And this trend is very much this trend parallels what's happening with just young people. We have another chart that just looks at 25 to 34-year-old population trends, and it mirrors this chart very well. So just like younger generations have been transitioning into homeownership later and later compared with their predecessors, today's seniors have been living longer and increasingly aging in place, which increases housing demand relative to previous generations. However, just like with millennials, their transition out of homeownership is delayed but it will happen at some point. Now, we know that the number of people 80 years or older is expected to more than double between now and 2040. And as the baby boomer generation ages into their 80s, which will start to pick up in the late 2020s, but really pick up speed in the 2030s, they will begin downsizing and selling their homes, which will put more housing supply on the market. However, we know that a lot of these homes will need some work. Approximately 1 million single-family homes owned by a head of household are considered inadequate. So homes owned by baby boomers, about 1 million of them are considered inadequate. In other words, they need a lot of work. But then there are still 32 single-family homes that are considered adequate, and a lot of those are in prime locations. 11 million are in the top 25 U.S. metropolitan areas, including New York, LA, DC. And so I think that that's worth keeping in mind. I suspect these homes will still need some updating and remodeling to be brought up to date and attractive to younger buyers. But I think given the highly sought after locations of these housing units, there will be buyers willing to spend the money for updating and remodeling. So, looking out into 2030 and beyond, the fixer upper might be popular again. But I think this is more important from a supply perspective, right? We're facing such a severe shortage of housing right now, but demographics will play a role in alleviating that supply shortage. Again, some takeaways from this section here, but I think the main takeaway is that the demographics for home buying will remain favorable in the coming years as we still have this massive generation continuing to age into their prime home buying years. From a longer term perspective, we have the baby boomers who will be aging out of home ownership, putting more supply on the market. So let's get to the supply side of the equation. We know demand on the sidelines is robust, but there's just not enough housing. And so in this chart, we're taking a longer term look at the housing debt, if you will. So new household formation compared to new housing completions is what we're doing here, and housing completions, that can be housing of any type, single family, multifamily, or manufactured. You can see that the difference between completions and household formation, we were overbuilding in the early to mid 2000s. We started to underbuild in 2006, and that underbuilding has persisted and resulted in a very strong deficit of housing. Here's a chart of historical housing starts per 1,000 households. So this goes way back to 1920. I always find that historical context fascinating. In the late 1930s, we were building anywhere from 500 to 700,000 units a year, which equated to about 15 to 20 units per 1,000 households. Post World War II, that ramped up to 1 million units, peaking at about 1.9 million units in 1950, or 44 units per 1,000 households. We've never built at this rate since. We know there was a massive building boom in the 1940s and 50s, GI Bill, we were building the suburbs. And then at the trough of the global financial crisis correction, we were building 5 units per 1,000 households, which is a series low. And we're currently building about 11 units per 1,000 households, which is about the same level as in 1991. So we need to increase the sheer amount of construction in this country to not only keep up with new demand every year, but also make up for the underbuilding that's been occurring for now over a decade. So not a lot of things that economists agree on, but one thing is that the housing market faces a severe shortage. Currently, we have 1.4 million units of housing under construction. That includes apartments and homes. If all of those units come to market tomorrow, ready to sell or lease, and there was no new household formation or destruction of homes or second home sales, that's still just about half of what's needed to meet the consensus shortage of 3 million units. But as we all know, the supply shortage isn't static because households will continue to form. So even assuming a more modest pace of household formation of, let's say, 1 million new households, at least that many new homes must be built just to keep up with the potential demand. So just wanted to give you some scope to the housing shortage. The mortgage rate lock-in effect has only exacerbated the inventory shortage. Historically, 90% of all home inventory is made up of existing home inventory, and existing homeowners are staying put. I'm sure you all know this. we know that existing homeowners are rate locked into their homes. The average interest rate on existing mortgages is 4.2%, far lower than the current prevailing rate available to new home buyers. In fact, 84% or 83% of homeowners have a rate below 6%, and rates aren't expected to dip below that threshold this year, according to consensus projections. The lock-in effect will eventually wear off somewhat as homeowners grow tired of waiting to move, but I suspect that it will continue to limit market potential in 2025. But I always think it's important to remember that financial considerations are crucial in deciding to whether someone will buy or sell a home, but we still have lifestyle events that drive the market. We often refer to them as the 5 Ds: death, divorce, diplomas, downsizing, diapers. So while mortgage rates are not going to go low enough this year to unlock most homeowners, the driving force behind sales will continue to be these lifestyle factors. So the full inventory picture here, overall inventory of both new and existing homes is low, even though there's been a bit of an increase this year, which is very welcome news for the housing market. Nevertheless, historically, about 250 in every 10,000 homes were for sale. In today's market, only 134 in every 10,000 homes are for sale. So we're still very much in an inventory constrained market. But I mentioned, this year we've seen a pickup in inventory. According to a new listings metric, housing supply has increased in 34 of the top 50 markets we track on a year-over-year basis. The strongest growth in new listings is concentrated in southern and western markets, and more muted in Northeast and Midwest. An increase in the growth rate of new listings can enhance the options available to potential buyers and obviously drive market activity forward. So our analysis here shows that as more new listings hit the market, there is a pickup in sales activity. So in this box in particular, you can see positive growth in new listings on a year-over-year basis, and also strong positive growth in sales as well. And we do expect higher inventory in 2025. And so with that, we're expecting a little bit more sales activity than last year. And that would be coming off a very low level, right? So here we're looking at purchase applications back to 1990. You can see that purchase applications are at about the lowest level since the early 90s right now. Though I should mention that in the last couple months, despite higher mortgage rates, purchase applications have remained steady. And I think that's really a testament to the importance of higher inventory. I think higher inventory has been one reason why we've seen purchase apps maybe outperform, given what we would expect with rates being so high. So just wanted to mention quickly 2 mitigating factors to the rate lock-in effect. About 40% of owner-occupied housing is owned free and clear. That means without a mortgage. That gives us some hope that while many existing homeowners are rate locked in, there's a large cohort of mostly older homeowners who are not. Though I should mention that older homeowners are less likely to move than younger ones, which is especially true of seniors today that are aging in place. So while some portion of the free and clear inventory will come to market in the next decade, it will be sort of a trickle. Maybe more importantly, homeowners today have a near record level of equity in their homes that they can use to offset higher rates, right? They can just they can use that equity to bring a higher down payment to the closing table. And then just to quickly touch on refis, very few people are in the money to refi at this point. We did see a little bit of a pickup last year. Most of that was rate term refis from 23 and 2024 vintages. Again, couple takeaways from this section, but for the sake of time, I want to jump into the next section, which just talks about the new home market. On the new home side, we just got fresh data on builder sentiment this morning. Builders were actually more positive this month than the previous month. So builder sentiment actually inched higher in January, despite higher mortgage rates. Though it's still in negative territory. Anything below 50 is still in negative territory. But it was good to see the progress And importantly, the outlook for single-family home sales was in positive territory. And despite the fact that builders are facing multiple headwinds, right? Supply side headwinds ranging from a lack of buildable lots, more expensive lots, a chronic skilled labor shortage, higher financing costs for builders, tighter credit, right? All of these factors that make it more difficult to break ground on new homes. Part of the reason for the optimism is that there is a lack of existing home inventory on the market, and so builders can sort of come in and fill that need. And then, of course, they have the ability to offer incentives such as mortgage rate buy downs, which is something that an existing homeowner can't do. And I suspect that mortgage rate buy downs will be quite common in 2025 market for builders, because they have a lot of inventory they need to sell, and you know, they'll do what they need to do to get that sold. In this last survey, builders revealed that about 30% of builders cut home prices in January. That's been pretty stable in that range. The average price reduction of a new home was about 5%, and the use of sale incentives was about 61%. That share has been pretty stable as well. So again, builders really taking advantage of incentives to sell that inventory. Here you can see new homes make up a historically high share of overall inventory, as existing homeowners have stayed put and kept their home off the market. Builders have sort of taken up market share. So the new home market has really been a relative outperformer in the housing market, and I expect that trend to continue this year, because again, existing homeowners are rate locked in. Builders do not face that same constraint. Same thing with sales. New home sales make up about 14% of total sales in today's market, so that's been steadily rising. Again, they have more inventory and they have the incentives available to sell that inventory. New home prices are down 13% from the 2022 peak. Median sales price of a new home is actually down to the lowest level since 2022. And part of that might be the price cut. I think that's part of the answer, but it's also this distributional reason as well. In the latest month, we can see that homes priced under $300,000, there's been a growing share of homes sold in that price range. So in November 2023, maybe we were around 17% of new homes that sold were under 300,000, whereas in November 2024 we're closer to 25%. So that is, we're starting to see that when homes are sold in the lower price tier, it pulls the median down, even if prices in the other tiers remain stable. So builders are selling homes at that lower price tier, which is good news for potential first-time home buyers. Builders are also trying to adapt to the current affordability environment by building smaller homes. So the size of a new home is actually the smallest since 2010. So again, I do expect that new home market will continue to outperform the existing home market this year. Builders have inventory they need to sell. They have the ability to offer incentives to entice buyers off the sidelines, which is what we've been seeing. We'll probably see a little bit of an increase in single-family housing starts, again, as builders are responding to the need for more homes. But there will be significant regional variation in where we see those homes being built, predominantly in markets where it's easier to build, where the regulatory burdens of building are lower, so in the South in particular. Now, the final section here is putting together the supply and the demand side of the equation, where we talk about prices and affordability. It's no surprise to anyone on this call that the affordability environment has been challenging, to say the least. Not only do we have elevated mortgage rates, but we have house prices continuing to reach new heights. Incomes have been growing, but it has not been enough to offset the impact from higher rates and higher house prices. Here we're looking at affordability growth for each of the top 50 markets, and then for sale inventory on the y-axis. So here we're looking at active inventory. So all the homes that are available for sale in any given month, not new inventory, but active inventory. So what we see here is a very positive relationship. The higher the for sale inventory, the more affordability that we're gaining in these markets. And that's really because if you have more inventory on the market, that can put some downward pressure on prices, particularly active inventory, which might be a home that's been sitting on the market for some time, and so you're more pushed to cut prices in that market. And so we can see here that Tampa, for example, for sale inventory was over 30% growth on a year-over-year basis, and affordability also improved by nearly 19%. And the biggest reason for that is because it's putting some downward pressure on prices. And speaking of prices, here we're also looking at the top 50 markets. The top part of the chart is how much prices increased from February 2020 pre-pandemic all the way to the peak in that market. And the bottom chart is how much prices have fallen, if at all, from that peak. So you can see in many markets, prices haven't fallen at all. In fact, prices continue to reach historic highs in these markets that don't have any blue bars assigned to them. But then you have markets like Austin, San Francisco, Tampa, Phoenix, where you see in Austin, for example, prices have fallen about 9% from the peak. But prices also increased 65% from pre-pandemic to peak. So yes, prices are adjusting downwards in these markets, particularly pandemic boom towns, as they're sort of recalibrating to higher mortgage rates. But the equity position of homeowners who bought pre-pandemic is still very strong, because again, you gained 65% over the pandemic to peak, and now you've lost, about 9% of that. So, even in these markets with price declines from the peak, there's still a strong sort of equity gains there from pre-pandemic. Nationally, we expect to look a little bit better than 2024 by the end of the year. And my assumptions for that is that we'll get some stability in house price growth, a little bit of moderation towards historical norms, so price growth between 3.5% and 4% on an annual basis, income growth in line with historical norms, mortgage rates may be ending the year at 6.3%, 6.4%, which means house buying power will be up about 6% on a year-over-year basis, which means affordability is up about 2%. So not a ton of improvement in affordability, but a little bit of movement. And of course, this will vary significantly by region. As you saw on that previous slide, markets that have more inventory coming online means that we might be able to get some more downward pressure on prices, and the affordability picture can improve more so in those markets. This is just a national outlook. And then, are there any markets that remain affordable to the potential first-time home buyer? Here we're looking at where renters can find the largest supply of affordable homes. So for example, the median renter with the median renter's income in Memphis can afford about 47% of homes available for sale. Now go to the other side, markets in California, the affordability picture for that median renter is not quite as positive, right? So if we look at San Francisco, the median renter can afford less than 5% of homes available for sale. So there are still relatively affordable markets for that potential first-time home buyer, but certainly elevated home prices alongside elevated mortgage rates has made for a challenging affordability environment. And something's got to give, right? It could be one of three things. We could have wage growth outpacing house price growth, which I do suspect might be the case this year and into next. And that could result in some affordability improvements. You can have some markets where prices decline, and certainly that would bring some affordability improvements as well. So there's different ways to get to it, but something's got to give. It's either income, mortgage rates, or house prices, or a combination of all three. And I think that where affordability improves the most will really depend on where you live, as we showed in that previous slide. I don't touch on it in this presentation directly, but I should mention, since I brought up equity, that our outlook for foreclosures is that we'll probably see more foreclosures this year as the labor market continues to slow, but certainly we're not expecting any kind of foreclosure wave. We know that foreclosures require a dual trigger. You need some kind of income shock event, like a loss of a job, a death of a spouse, to make you unable to pay your mortgage. But then the other thing that you need is a lack of equity, right? You need both of those things for foreclosure to happen. And in today's market, they've been resilient, but equity levels are near historic highs, and so those should prevent any sort of foreclosure wave. though again, I do expect foreclosures to pick up a little bit as the labor market continues to slow. So here are the takeaways from the affordability section, everything we just talked about. And then my last slide of the presentation is really just a recap of the whole deck. We do expect mortgage rates to remain elevated this year, but affordability might improve modestly on an annual basis as we see rates come down from, today they're at 7% down to the low 6s as income growth remains positive and as house price growth moderates. Which brings us back to our second point. We expect house price growth to moderate but remain positive nationally. We should see some improvements in inventory at a national level, but we don't necessarily expect inventory to get back to historical norms. We do expect some improvement in existing home sales alongside rising inventory, but still remain below those normal levels due to the rate lock-in effect. And we do anticipate that the new home market will remain a bright spot in the housing market. And as always, location matters. If there's anything you take away from this presentation is that while during the pandemic we were seeing double-digit house price growth everywhere you looked, I think real estate is very clearly local again, and you can see that there's a lot of local and regional dynamics at play in today's housing market. So that's it. Hopefully, I think I left some time for questions. You can find our research and our blog posts on the Econ Center. You can use that QR code to get there. And then our chief economist and myself, we co-host a podcast called the Economy Podcast. We publish a new episode every other week, so you can find us there as well. And thank you for listening. I am going to stop sharing my screen and turn it over to Jeremy for any questions that have come in.
All right. Thank you, Odeta. Lots of data, stats to chew on. I always find it fascinating to try and find my town, Columbus, Ohio, where we sit in the grand scheme of things as far as builds and affordability. And it seems like around here there's multifamily going up everywhere. And you would think it would result in, it help this affordability, but rents just remain very high, at least from my perspective in the Midwest, not as high in New York or LA's, but, still high. Anyway, enough of my perspective on that. We do have some time for Q&A. Submit them in the questions box, and we'll pitch them over to Odeta. Just a reminder, the webinar is being recorded, and so if you missed parts or you think others would benefit from listening, again, you'll get a link to the recording tomorrow, and you can always access our archive at alta.org/webinars. Question kind of about, well, it's actually on your last slide, the states that are seeing increases in the housing supply, southern and western states. Are there any in particular that stood out to you?
Yes, we've seen an increase, particularly in inventory in Florida and Texas market specifically as the states. In fact, if you look at growth in overall inventory at the national level, I encourage you to look under the hood a little bit, because oftentimes what you'll find is that it's dominated by some states or a couple of key markets, and that's certainly been the story of 2024 is growth in listings in Texas and Florida markets.
I thought the slide that showed that 40% of owner-occupied properties are free and clear without a mortgage. So if you add that into what I think you said 90% have mortgage rates less than 6%. Was it 90%?
83%. 83%.
Okay. How do you break through that then? So if you don't have a mortgage and then there's a large group of people that already have a low rate, what's the end game there? How do you get people to move?
I really do think it's a life happens. And we're seeing that in today's market, right? Even with this rate lock-in effect, we're getting 4 million sales annualized. That's still people driving the market forward. A lot of those folks that are rate locked in, they'll, if it's a millennial that maybe bought a starter home over the pandemic and they eventually get married and have a kid, they'll have to move and give up that ultra low rate. On the free and clear share, we do find that they typically are older homeowners, have been in their homes for a long time. So that I think plays well with the demographic, baby boomers aging out of homeownership that I talked about earlier, which I anticipate the sales of those homes will really pick up speed in the 2030s, and we'll get more supply on the market from that. But we're seeing inventory rise, right? There's the mortgage rate environment's been sort of like the stages of grief, right? Like we denied it at first. We're like, no way, that rates aren't going to come back down to 4. I'm going to hold off. And now I think there's a level of acceptance. This is the new normal. Historically, rates of 6 to 7% that's the historical norm. The reason it feels so hard is because we have 6 to 7% mortgage rates alongside historically high house prices. And so we really need income growth to pick up speed a little bit, outpace house price growth, and get some improvements in affordability.
Yeah, I think if you think back over, my first house, 6% or not 8% mortgage rate, and I've had, a few other houses in between, since then, and they've varied from my current, which is about 3. So, it's cyclical, right? More rates will come and go, and we had 3% for a few years during COVID. The slide that you had that showed the inventory of new homes versus existing. Was COVID kind of the driver of why they inverted, or were there other factors that led to new homes being a significant percentage of inventory?
That's a great question. So it was a combination of both. It was new home inventory picking up speed. So there was just a lot more new home inventory on the market, and then existing homeowners in the aftermath of sort of that low rate environment choosing not to sell and keeping existing home inventory off the market. And so both of those factors contributed to the new home side picking up market share. I do expect that to continue this year, because the rate lock-in effect's not going away. It's still going to hold back market potential this year.
Okay. All right. We're coming up to the top of the hour. Maybe 2 more quick questions, and then we will wrap up. Kimberly asked, so we don't think house prices are going to go down. It sounds like, supply is slowly growing, but there is demand. So, simple economics, probably not so. I mean, the increase maybe won't be as much as far as home prices.
I think so. So home prices tend to be downside sticky, right? The global financial crisis was the exception, not the rule. And it's because we had a lot of distress flooding the market, bringing down house prices. But for the most part, if I'm a homeowner, I'm not taking a price cut on my home if I can choose to stay in it. And so house prices tend to be downside sticky. Ultimately, the outlook for house prices will depend on supply and demand. So there will be markets where you've got a ton of active inventory and it's just sitting, it's not priced correctly. And those homes to sell will eventually need to take price cuts, and you'll see house prices maybe even decline in those markets. But nationally, we're expecting that the supply and demand sort of tug of war will result in single-digit sort of historical norms house price growth this year.
Okay. All right. On the call today, we've got title agents, title professionals across the country. Boil all this data down, kind of a percent increase over 24 title orders in 25. What kind of business can everyone expect?
Great question. I think we'll get, I'm not going to give you an exact number, but I think that we'll get a little bit of progress over last year. With the expectation that mortgage rates will come down to the low 6s by the end of the year, maybe we'll get a little bit of bump in refi activity for those 23, 24 vintages and a pickup in purchase from last year. And we might have some single-digit growth over last year. So one step closer to normal.
A little bit incremental. So there we go. All right. So, well, thank you, Odeta, for sharing your expertise and data crunching and how it impacts the title industry. Again, as a reminder, you'll get an email tomorrow with a link to access the recording of the webinar and a copy of today's presentation. I do need to thank SoftPro once again for sponsoring today's webinar. Follow Odeta on X, there at Odeta Kushi. Again, our webinars are archived at alta.org/webinars. And with that, that will bring us to the end of today's presentation. Odeta, thank you again for joining us.
Thank you.
All right, take care, everyone. Bye.
Thank you, everyone.